Good morning, everybody. It's right at 10 o'clock. I just opened up so that everybody can start jumping onto the webinar and we can get going. So I'll give it a minute or two, not really a minute or two, but about a minute. Let everybody get logged in and online, and then we'll jump right into it. Okay. All right, looks like we've got everybody coming in. I do need to check one setting, make sure I'm on the right microphone. So yes, in case one of my 3 dogs that are in here with me start to bark, I can mute it very quickly without doing the Zoom fumble of, hey, where do I turn that off? So let's get rolling. I do have the window closed so they can't just see any delivery driver stuff. So let's get going. Those that don't know me, you probably already know me. I'm Amy Knight, and I say that because I did not send out this invitation to the general masses. I've sent it to the people that stay engaged with us and listen to what we have to say. But I welcome you to our Wednesday webcast. It's been a little while since we've had one. I do plan to get back on track, and I'm going to try to plan them out for the year so they can be on our website as upcoming events, and they can be kind of structured. And I'm ready to get away from COVID updates, as are you guys, I'm sure. But as we all know, I don't think it's going away anytime soon, but we really do want to try to get a focus back on regular business. However, this Wednesday webcast specifically is about the employee retention credit, but it's a different angle. So I've done these, we've done a few of them. We've put out a lot of information since the beginning of this year. It was last December, I believe it was December 27th or so, that President Trump at the time signed the American Rescue Plan, I think was the name of that bill. And it opened up, so ERC credit came about in the original CARES Act. The problem was that if you qualified for PPP loan, it disqualified you from ERC. So we ignored it because everybody went and got a PPP loan. And that was how it worked for a while, until December rolled around and Trump said, hey, we need to do a couple things. We need to extend this credit, but we also need to open it up and not penalize those that got a PPP loan. They should be allowed to take it as well. So that changed everything. So this year, we've done a lot of ERC credits. The credits we've done, there are 2 ways to qualify. We'll get into that. We did the qualification based on decline in revenue. So you had a decline in revenue, you qualified, we filed for the credit. A lot of them we're still waiting on. A lot of them we've gotten. It depends on how it was filed. And that's cool, right? Well, there's this other, the second way is this partial government shutdown. That's what we're going to go into today. It's a more aggressive approach. It did not require the decline in revenue to happen. And it involves getting an attorney. Like, we need an attorney to get involved in this. So that's what we want to go over here. I do want to point out, because I just had, okay, somebody, Denise Huff cannot hear. Can everybody else hear me okay? If you guys could put in the chat panel if you're having any difficulties. Denise, if she can't hear me, let me message her back. Sounds I'm not getting any messages otherwise if you can hear or not. Okay. All right. Becky says she can hear me. So let me tell Denise, might want to log in via phone. Okay. Okay, it sounds like we're good. Maybe Denise is having difficulty. It is, so a couple things. It is being recorded and will be, sorry, let me post this to everybody and not just, sorry, technical issues, right? Luckily this didn't happen yesterday. Was Amazon Web Services down. Okay, anyways, if you were not aware, we're very, very web-based and techie over here. And Amazon Web Services went down yesterday for a big chunk of the day. It took a lot of software applications down. So sent that message out. So a little housekeeping. This is being recorded. We will send out a follow-up email tomorrow to everybody that registered. So we get about a 50% attendance. So everybody that registered and then about 50% show up. I send this out to everybody that registered. So you'll get the recording and any materials, so the handouts, which I'm going to say are not very detailed. This is very high level approach. And then any other links that I might want to get out to you. So that will all follow up tomorrow. If you have questions, please put them in the question and answer panel. If you go to that box, that will allow me to track what I've answered and not answered to make sure I get everybody's questions answered. I am here until you're done asking questions. So if it's super detailed, I may not know the answer, but feel free to ask your questions and I can either get back to you, or if it's super specific about, hey, I had this happen, do I qualify? That's where the legal team has to come in. So I'm not going to be able to answer a lot of those questions. This is more to talk about the process, how it works. I can talk a lot about the credit itself, what it might be worth to you. And so that's kind of the angle we're going to go here. And then at the end, I will talk about our service offering, how that's working, what our fees are, and go through that with you. So, all right, sorry. Those that know me know I have allergies, and so I have the sniffles today and all that good stuff. Anyways, all right, and I did get all made up. It happens to be my birthday, but I told my staff, I said, well, I didn't get my hair washed and dried for my birthday. I did it because I have a presentation to give today. So let's get going, guys. All right, so what is this? ERC is the Employee Retention Credit. You've probably already heard about it. So I just want to jump into, what's it worth? How is it, not technically, how's it calculated, but what are all the pieces of it, high level pieces? It differs between 2020 and 2021. And the difference came out of that ARP, that American Rescue Plan that Trump signed into law in December. And so these are the changes that were made. So 2020, you had to show a 50% reduction in revenue from one quarter of 20 versus the same quarter in 19. However, in 21, they reduced that to a 20% reduction. Huge difference there, huge difference. So in 21, if you had a quarter in 21 with a 20% reduction versus the same quarter in 19, then you were eligible for the credit. They both still maintain this, quote, partial government shutdown. We will get into that a little bit later. So that's on there. Yes, you can still look at 2020. We have not missed any opportunity for any of these quarters. All of it can be filed after the fact. The only deadline is the statute of limitations, which is like 3 years. So there's lots of time for this. So let me put that concern to rest right away. PPP. So again, PPP was a restriction, then they removed that restriction. So it's not a restriction for 2020 or 21. In 2020, the small employer was defined as 100 full-time employees versus 2021, I hope I said that right, 20 was 100 full-time employees, 21 up to 500 full-time employees. I need to verify, but I'm 99% sure that, and I verify because there's so many different credits and things that we work on throughout this COVID circus. When they say full-time employees, they do not mean full-time equivalents. It means actual full-time employees. So an employee that averages more than 30 hours a week on the regular. So that means if you have 3 employees that all do 20 hours a week in a full-time equivalent, that's 60 hours a week, that would be 1.5 FTEs. In this count, that would be 3 part-time people because they each only average 20 hours a week. So very, very careful. Well, I don't want to say careful, but clear, be very clear with that, because I know a lot of you out there have PAS programs, right? Which, not to jump around, my talk here is exclusively home health, home care, hospice, nursing home. If you've got outside businesses, what I'm talking about on partial government shutdown will not translate to another type of business. That doesn't mean they don't qualify under that rule. I have no experience with it and I can't speak to it. So be clear on that. So again, 500 full-time employees. So if you've got a big PAS program, how many full-time people do you have? So that's what you want to measure there. And so if you know you're a skilled provider and you know you've got a bunch of full-time employees, like more than 500, then you don't qualify. And so the rest is all a moot point. So in 2020, there was a limit of $5,000 worth of credit per year per employee. So the max you could get is $5,000 per employee for the entire year. Fast forward to 21, another drastic change was that they're now allowing $7,000 per employee per quarter. Now, one thing I did not update on these slides, Michelle, could you add this to my notes? I need to add so that when you're looking at it in writing, that fourth quarter 2021 is gone. The latest bill signed by Biden removed, don't even ask me what that one's called. It might have been the infrastructure bill. It's not the Build Back Better. I don't know what it was called, but the latest bill actually signed did remove quarter 4, 2021, no more ERC, okay? So for 2021, you've got a potential of $21,000 per employee because it's $7,000 per year. And it depends on how much they're paid. So we'll get to that in a minute. I skipped a point here. In 2020, it was 50% of employee wages is what the credit was, up to $10,000 per employee. And again, in 20, that was per year. In 21, it's 70% credit, up to $10,000 in wages per employee per quarter. So that's those 2 bullet points right there. In 2020, and this, I haven't had this impact anybody yet, but in 2020, you could not increase salaries to maximize the credit. In 21, they removed that restriction. This next one, actually, I'll just take that off. Yes, you can request in advance, but that's a moot point now because we're past all of the live quarters. And honestly, requesting the advance did not work anyways. We filed that in first quarter of 21. Nobody got an advance. It didn't work. The IRS is way too backed up. You could basically say, hey, I'm going to have $100,000 credit. I want it now in advance of you having time to calculate it and pay it out correctly. And that didn't work, frankly. And then eligibility, and I won't get into that too much, but in 21, they changed it to where you could do a look back, meaning if quarter 1, let's say you qualified in Q1 based on decline in revenue, then in Q2, Maybe you did not qualify in Q2 for Q2 being declined revenue, but Q1, you were able to look back at Q1 and you qualified in Q1, automatically qualified you for Q2. That can get very complicated. Again, it is a moot point on the partial government shutdown angle, okay? I do have a few questions here. Let me answer them. Amy, is it per employee or per one FTE? It is per employee. It's not FTEs. FTE, for those asking, is full-time equivalent. And that's a way that you take, let's say you take all of your hours, like say you have all your attendant hours paid for the month, divided by total number of hours in the month, like work hours, and that's your FTE count. That's your full-time equivalent. But the fact might be that you have a whole bunch of attendants that work 20 hours a week. Then you have no actual full-time employees if they all work 20 hours a week. But when you aggregate them all and divide by total available hours, it looks like you have full-time equivalents. Those are two different things. It's super confusing. It's totally understandable that this is a confusing topic. And, you know, SBA, small business guidelines, have one calculation. ACA, Obamacare, Affordable Care Act calculations have a completely different calculation for that. It's all over the place. Another one is along those same lines. I have providers that have hours ranging from 20 to 40 hours per week. Ernest, that's where it's going to get tough if they, you know, and we'll have to dig into the details to evaluate what is your evaluation period. So what period of time are you going to look at to say, all right, this quarter, I think you might do it by quarter. This quarter, John Jones worked, you know, 112 hours divided by, you know, however many full-time hours there are to get a number. And it's going to be a employee by employee calculation. It's not, okay, so if you did that for a month and they worked 120 hours for the month and there were 4 weeks in the month, they averaged 30 hours a week. So 30 or more is full-time. So unfortunately, this is all in hindsight. So we can't change any of that. We can't minimize how many hours they work. We can't, like in Obamacare, a lot of what happened was we kept all of our staff under 30 hours a week so that they did not qualify for having to provide insurance and then get penalized if you don't, right? So that's how I would approach that. If it's 30 or more for that average calculation, then they're a full-time person. If it's 29 or less, then they're part-time. So that's going to be something that's going to have to be worked through. And again, employee by employee is how we have to calculate that. If an agency has way less than 100 employees, will that company qualify? Yes. Yeah, you will. So if you have less than 100 employees for 2020, fully qualify, don't have to worry about any employee calculations, and then definitely qualify for 21 as well. All right, so that's all of our current questions. Keep them coming. As you see, I'll stop and answer. So let's talk about this partial government shutdown. That's the phrase. So part of the regulations, again, there were two ways to qualify. Either you could show a decrease in revenue, or you could qualify under this, quote, partial government shutdown. Excuse me. And I will say, I have simplified this. These are the two ways, but it could get very, very complex when there are some other rules. And so what I get a lot of is, well, I was talking to my neighbor and they said you could do this, this, and that, and they got this and they got that. And, you know, I'm not working with your neighbor, so I can't answer all of those questions directly. They're part of this government shutdown and even part of the 500 employee rule, I believe. If you had to close your doors but you kept employees on because of a government order, but you kept employees paid, then the time that you paid those employees and they were not working, that qualifies. But this comes down to a day by day decision and calculation. That's not what we're doing, and we're not getting into all that because, again, I clarified up front, this is for our home care community, nursing home community. You were not shut down. You were deemed an essential business, so you didn't have a direct government order shutting you down, not allowing you to operate. So please, hold those questions, because that's not what we're evaluating. So what we're evaluating here is this partial government shutdown. And there's a whole slew of FAQs, frequently asked questions. Those cannot be relied upon as law, but they help us interpret how the IRS is going to apply this law, okay? And in those FAQs, it goes into a lot of different examples. None of them are exactly healthcare. That's where the attorneys come in. And they do their job at evaluating what's been laid out and figuring out how can this home health agency that had to drastically change the way they did business, these government orders affected them and they had to make drastic changes which constitute a partial government shutdown. That's the angle that we're going at here. So if you had to make significant changes to how you operate, that is how you might qualify for this. It is federal, state, or local orders. And that's how the legal team is going to go in. They're going to look at where you're located, your service area, and what were the federal, state, and local. Local could be county, it could be city, it could be jurisdiction. I don't know if it could be school district, but any kind of local order, they have to go dig all of those out, read them, apply them to you, and see how your adjustments affected the way you did business, and does that then qualify for you for this. I don't think anybody would be willing to say, I didn't make any changes at all. I don't think that's the case. Now, did you make enough changes to be considered significant in the eyes of the government? Maybe, maybe not, but did you have to space out your office staff? Did you have to start contact tracing? Did you have other standards of donning and doffing your PPE? Maybe you already did that, right? You're probably going to be able to identify a lot of things that you had to change. And that's what we're after on this. Now, that's where I say I'm going to brush over it, because that's not my role, is not to qualify you. And therefore, I'm not the one that has researched exactly what change equals this. That's not my role. That's the legal team's role. So that's why we've got somebody that can step in and get that done for you. So to determine if you qualify, I'm not comfortable calculating the credit with you just saying, oh yeah, I qualify, because my fee is contingent upon you receiving a refund. I don't want to go do the work and do the calculations and then IRS kick it out. I want to have solid evidence and have done our due diligence that you truly qualify. We're legit. We're not filing frivolous claims here that we're all later going to get in trouble for. If you don't know me very well, next year will be our 20th year in business. This is all we do is home health, hospice, nursing homes. We do full back office accounting services. And the reason I point this out is I have a reputation at stake. I'm not one that's just popped up overnight. to then go do a bunch of ERC credits and then be gone. The reason I was slow to roll this out, this partial government shutdown, was because I needed to ensure it applied to our audience. And at the same time, I wanted to make sure it applied to everybody and it was legit. And that took time, but I also want to make sure, and the reason why I am rolling it out, and if you logged on a little bit late, I said I did not send this out to my entire audience. I sent it out to a select group, those that have been engaged and have attended our webinars in the past, because I want to do a limited number of these. I want completely legitimate cases here that we can stand behind and say, no, we did the due diligence. We have ensured that they do qualify. Our position is they qualify. We've got legal opinion that says that. And so I can sleep at night. And there are agencies or providers popping up just to do ERC credits. And they're going to come in, they're going to do them, they're going to collect their fees, then they're going to be gone. And that's not me. I've got longevity here. I've got a reputation to protect. And so I did do this slow, but at the same time, I wanted to make sure I was offering it because I know that others are soliciting you and offering it to you as well. So I wanted to make sure you had a trusted source that you could go to that isn't just here to make a quick buck and be gone. So a little bit on that piece there. So again, back to the due diligence that needs to be performed here. The way we're approaching this is you need to have a legal opinion stating that you qualified for this credit. In the beginning, there were some nursing homes specifically that they definitely qualify. We met with some consulting groups that were doing these credits and we felt very confident they qualified. And we say, you know what, let's do the credit. And if it gets reviewed, then we'll go get a legal opinion later. I've actually reversed that opinion now. We're in the process of getting those legal opinions now. What we're finding is that for the legal team to go dig out all of those government orders, the government's not making them readily available. There's a lot of digging that has to be done to get to all of the orders that impact you. And we need that. That needs to be in the file to prove that you qualified. And if we're under this assumption of, oh, we'll do that if and when audited, that might be 2 or 3 years down the road. How much harder is it going to be to get that government order when we need it? If it's hard to do it now, it's going to be 10 times harder in 2 or 3 years. So we've kind of reversed our stance in that says, okay, we're going to be a little bit more proactive and get those now. And again, it was one group that we filed with that we've gone back since and said, okay, let's go ahead and get this opinion letter done now. Pardon me. Lastly, I want to point out, if you are not open, if you're risk adverse, you do not like risk, this may not be for you. It is an aggressive approach. Is it legal? It's legal, but it's not cut and dry, black and white. Like the decline in revenue is black and white. The law is black and white. There is no room for interpretation. It is, you had a decline in revenue or you did not. There's not even question about what's included in revenue, what's not. It's super cut and dry, super black and white, what us CPAs like. So to me, there was no risk in that. Either you qualified or you didn't. But this approach, there's a lot of gray area and there is a lot to be left to interpretation. And there is no precedence, right? It's not like the court system, the tax court has heard cases on this and we can go and say, hey, you made a determination this way. We feel like our case is the same. We should therefore also qualify. So there is a risk there. I think you've got healthcare on your side, and maybe I'm incorrect there, but I'd like to think I'm the type of person that sees the good before I see the bad. And I would like to think that the government would come in and see, hey, these are healthcare providers. We're going to give them the benefit of the doubt because they're on the front lines, right? So that's a bit, again, that's just my opinion, and it's not legal. So you want to make sure that you're willing to be aggressive and go get it. I've got people on every end of this, on both ends of the spectrum. There were people that I worked with that said, I don't want the government's money. I don't trust them, and they can just keep it. I'm doing just fine, and I can sleep better at night that way. And then I've had people on the other end that say, you know what? The government does nothing but cut our rates. We're out here providing really good care and a service that's needed in the community, a service that's far better than hospitalization. It's the best piece of healthcare in our entire healthcare system. And all they do is slam us and cut our rates. I'm taking every dime that I'm legitimately eligible to accept. So, and then there's those that fall in between. So you're going to want to assess your risk tolerance for yourself. And then if you're, want to go for it, then by all means go for it, because I didn't put any estimates up here. I will get to how we calculate the wages here in just a couple moments. These can be very lucrative credits. Basically up to $7,000 a person. We say for 2021. And so we say up to, because we'll get to that in a minute. Let me not get ahead of myself. So to do this, we need a legal opinion letter. And that's a technical thing that comes from a law firm. So we have attorneys, and one reason I was slow on rolling this out, I was really trying to find an attorney that would work with us to get this done. I've got that law firm identified. I'm trying to work with them to figure out what's this process going to look like. But I was also being asked over and over, are you going to do this? Are you going to do this? So I went ahead and rolled out this marketing campaign. Hey, we're doing it, even though I don't have all the pieces figured out yet. I've got the law firm figured out. I just don't have the entire process figured out. Like, okay, the first thing we do is we schedule a call with you and the law firm and go over their exact scenario. I don't know all of those pieces yet. But what is an opinion letter? They're going to come in, they're going to meet with you, they're going to go ask you a whole bunch of questions, and they're going to establish that, yeah, we feel like you qualify, or you know what, it's pretty questionable, we need to do some research, or yeah, those changes just didn't cut it. With that, then they're going to write a legal opinion letter that states, in our legal opinion, this agency qualifies for this credit based on the laws as written under these parameters. They made these changes, yada, yada, yada. It's going to be super detailed and lay it out, and then have all the supporting evidence to go with it. That essentially is our ammunition come an audit or a review of the credit, okay? It still is not a guarantee that the IRS is going to side with us if it were reviewed. So that, I just want to make sure everybody's clear on that. Now, the taxation of this credit, you are going to be taxed on it. The way it is supposed to work is you're not allowed to deduct the wages that you got credits for. So let's say you pay somebody $10,000 for the quarter and you got a $7,000 credit. So $7,000 of that employee's wages are non-deductible. The way the law reads, the credit itself is not taxable income, but you can't deduct the expense that resulted in a credit. So then the easy layman's way to say it is whatever credit you get is taxable. 6 one way, half a dozen another. I only say that because inevitably I have somebody come up to me and say, hey, well, I just read that is not taxable income. Okay, technically that's true, but you can't deduct the expenses. So therefore it's taxable income in another roundabout way. Now, the law or the government, the regulations state that you're supposed to go back and amend the 2020 tax return, which has already been filed, to remove those wages and therefore owe those taxes for 2020. Here's my problem with that. You haven't received the refund yet. So our stance is we're not recommending anybody amend their tax return for prior year until you receive the credit. That's our stance. It's not the government stance. They say you're supposed to amend it when you file for the credit. I'm not recommending that. IRS can come after you. If they haven't issued the credit yet, then I don't know. That's where I'm at on that. Correct, Dean. ERC is not available for fourth quarter 2021. They did remove that in this latest package of legislation that was recently passed. Of course, it got no press and no news, but they did remove that. All right. Lastly, well, not lastly, ERC credits and PPP forgiveness. The main thing is you cannot double dip these two. That means you, if these wages were included in your PPP forgiveness, they cannot then also be included in your ERC credit. So that's really going to impact everybody mostly for 2020. Now, and also let me be clear, I haven't mentioned this and it's actually not on there. For 2020, we're looking at the period of 3/13 forward. What that means is 3/13 to 3/31 is in first quarter, but that's the only piece of first quarter that qualifies. And it actually goes on an amended second quarter form. So we're really, let's just, for practical purposes, we're looking at second, third, and fourth quarter of 2020, and then first, second, and third quarter of 21. So 6 quarters total, plus a couple weeks in March. Effectively, if you've got a PPP loan, effectively wipes out second quarter. It depends. It depends on, one way to look at it. And this is what we will do in this planning. Let's say you have high paid, am I doing that right? High paid or low paid? I would have to think through that. If you have, I'd have to think through that. But remember, employees max out on ERC. So we could max them out on ERC and let the remaining wages go to PPP. It just kind of depends on how your PPP forgiveness was submitted. Really, the conservative approach has been, all right, show me the date range of wages used for PPP, and I will not use those date ranges for ERC. That's how I've approached it so far. If you got PPP2, we did a lot of these credits for the decline in revenue. We were able to really strategize those and say, okay, PPP2 came in first quarter, but first quarter also qualifies for ERC, but PPP has a full 24-week. I don't know if second quarter is going to qualify. So I'm going to use Q1 for ERC, and then I'll use Q2 for PPP. And then if Q2 also qualified for ERC, we would have to kind of juggle things then, but it was live and in front of us right then, and we could really strategize how we applied the dollars where. So we went into those analysis. Again, it's kind of going to be hard because a lot of that has already been done. If you got PPP2, have not applied for forgiveness, you might want to consider this before applying for forgiveness, because that still gives you time to jockey things around if you've got that timing. Dale is asking, what about work opportunity tax credit, FFRC, okay, all these other tax credits for other things. So all of them are a no double dip policy. Work opportunity tax credit, that brings in a real unique perspective. I would have to do some homework on that one, because that's a little bit more of, it's still a credit for their wages. I would say that's going to work the same way. You got to pick one or the other, but I would have to look into that one specifically. The other, the FFCRA and the APA, or ARPA tax credits. So when somebody was out with COVID and you mandatorily had to pay them, and then you got a credit on your tax return, your payroll tax return, those wages are also excluded. The good thing is that shows up separately in all of your payroll registers. Those wages are shown separately, like these qualify for FFCRA credits. So it's very easy for us to exclude those for ERC. So those are excluded and cannot be double dipped. Pretty much all of them can't be double dipped. I'm pretty certain that WOTC credits, WOTC credits would also fall into that. That's a work opportunity tax credit. If you have a PAS program and you are not taking advantage of those credits, you are missing out on a lot of credit opportunity there as well. And that's not something that we do. You want a good payroll company, for the most part, typically does those. Did I get everything? Yeah. All right. Another thing I also want to put out to everybody is the timing of these refunds, because I really, really want you to set your expectations. This is not a Hail Mary, you're in financial trouble and you need cash. Now, I will say Dale that just asked the last question. He shared a very, very interesting program with me about accelerating your refunds. So I'll share that with you. It's not something I'm currently offering, although I might reach out to that company and see if it's something that we could offer. But the timing of the refunds, this is a long process. I want to set proper expectations, but the refund in general is I'm telling people 8 to 12 months. My plan is I wanted to roll this out because so many people were asking. I want to get everybody on the books. I will cap out how much we take, how much work we take. I'm not there yet. I've got spots available, but I'm hoping that a lot of you guys want us to do it, and that will cap us out. So I would say, and again, I'm not a salesperson pressure kind of thing. If you want us to do it, I would highly encourage you. We're not charging anything right now until I do get the next steps figured out, but we do have our engagement letter out there ready to go. So you can sign up, get on our roster and be on our book so you're secured a spot. And I would even be fine if you change your mind and say, you know what, I thought about it more, I don't want to. So you're not locked into anything until we, charge that first fee and get things going. My plan is to have all that set up and then be ready to start doing calculations into the middle of January. And my goal would be to have everybody on board, figured out, and my piece of the work done no later than first quarter 2022, because I get into busy season. And I really probably need to do it more like the end of February. So that's kind of my time frame. And then the refunds are all going to be based on amended tax forms. That's what's taken a long time. There were a couple of ways during 21 to get that credit. If we were able to calculate your second quarter, you had your revenue numbers in a very timely manner. We ran the analysis, you qualify, you have not yet filed your quarterly payroll tax returns. And whoever does your quarterly tax returns is easy to work with. We can calculate the credit, give them the numbers, they put it on the forms for you and file it electronically. Those refunds were received 4 to 6 to 8 weeks. I think the longest I saw was about 8 weeks. And they still come via paper check. I think I had one client who's not always it's a nursing home, not always in the facilities. I haven't got my refund. I said, has anybody checked the mail for you? And do you have a stack of mail on your desk? Have them go check that. Sure enough, there was the check sitting there. It was a large, it was $350,000 credit sitting there on his desk. But these amended forms and so the way it works is, honestly, we just amend your 941 tax return that's already been filed. When we amend that, I believe the IRS has a special unit for ERC credit processing, and they're slammed. This is a while ago, but I felt like it was this past summer. There was a Kansas senator that wanted to investigate what's going on with the IRS. He had a lot of constituents complaining that it's taken so long to get anything done. And, the IRS is trying to offer these advanced credits, but nobody was getting funded. And he went over to their local office. They have a big processing center in Kansas. I forget what, Manhattan, maybe. I don't remember. And there were 19 semi trucks sitting in the parking lot full of tax returns to be processed. So just let that sink in. That's how far behind the IRS is. These are being processed manually. Again, it's the IRS. So that's what we're looking at. It is a long process. Okay, so I think I've set that expectation. So what's our service offering? So again, we've partnered with a law firm. It is, I cannot pronounce all these names. It's BNDJ. They are here locally in Texas. We may have some Oklahoma attendees here. I'm not sure. You know, I'm from Oklahoma. I'm not talking football yet. I'm not in denial. Don't get me on that soapbox. I'm excited about the new coach. I like Venables. I like college football. It is Bodkin, Niehaus, Doris, and Jolly. It's the name of the firm that has agreed to work with us. The reason I wanted a firm is that is doing this. I didn't want my clients to have to pay for all the research that went into learning and getting up to speed on this. I want somebody that's already done the research and they say, yeah, we know how to apply it case by case. And so that cut down the fees on those opinion letters drastically. So I'm also working with him to get a fixed rate for these opinion letters. So it's not just like an open-ended hourly bill that are very common with law firms. We will do the calculation of the credit itself. We don't need a ton of information, believe it or not. What we do need, and it's not required, but if you have a lot of employees, we are going to need your payroll data in an Excel format. If PPP is involved, it really needs to be paycheck by paycheck. And it's got to be in an Excel format that I can manipulate. But those are details we can get to later. We will do the credit calculation. I'll tell you what the credits are, and I will amend all of your 941 forms. We do amend quarter by quarter by quarter. We don't just do fourth quarter and pile it all on that. I've heard of some firms doing it. The IRS was very clear. They did not want it that way. If you're very small, I could see doing it that way, but we've been doing quarter by quarter. We will have a link to our engagement letter. It's an Adobe sign. You can click on it. You fill in your name and address. It's got all of our terms, which are on the next slide, and it's got your payment information right there. Our fee is 15% of the credit, which is fairly standard. There is a minimum of $5,000. And here's how we're going to collect that. We're going to collect the $3,500 upfront to engage the legal team. That will cover the opinion letter. So this fixed fee that I'm saying we're going to get from the legal team, that's coming out of my 15%. So I'm paying for that. So let's be very clear on that. But that part is that upfront is non-refundable because we're going to get that regardless of what happens later on. And then our fee, $1,500, to really get us, you know, some skin in the game for us to calculate the fee for you. Both of those are going to be non-refundable. The remainder of the 15%, so 15% less this amount, will be due upon receipt. So when you, upon receipt of the refund, not of the invoice, when you receive your refund, then you pay my piece of it. Same thing, when you receive your refund, then let's do the income tax side of it. So you're not paying any upfront cost aside from this $5,000 to then get the credit. And I think that's different than a lot of providers out there. Not a lot, but quite a few. We have held true to this. Actually, our original engagement letters stated the sooner of 75 days or receipt of refund. When I saw how long it was actually taken to get these, I removed this 75 days in this newer engagement letter. My intent was that it's due upon receipt of the refund. So we do require that we get a power of attorney so that we can check your status, your account with the IRS. That allows us to pull a transcript and check and see if you've been refunded yet, right? And also more, just as importantly, it allows us to call and check the status. of what's going on. It also, with us having a power of attorney on file, any letter that goes out to you comes to us as well. So we can really just kind of keep tabs on how things are going. Side note, the IRS is not sending letters saying, hey, we got your forms, we're processing them. They're not at all. So that's all I got. So again, I'll leave it there. The one thing I mentioned that somebody on the call, Dale, shared with me is there is a firm that basically a financing firm. So there's another group that's doing this credit. They're very reputable. They're very good at what they do. This is all they do, but not just for ERC. I think they do WOTC credits. I think they do a lot of credits. They're charging 16% and they want to be paid upfront. The way they're facilitating that, the unique part is they've partnered with a capital firm that basically you sell the refund to them. They front you the money, less, I think they hold back. I think their fee was 5% of the credit, plus they hold back. They don't hold the money. Let's say you have a $1,000 credit. They're going to charge you $5,000, and I think they're holding back $25,000. And when I say hold back, let me explain that. So they're going to front you $70,000 for your $100,000 credit. When the credit comes in, when the refund comes, then you get that other 25% or $25,000 holdback. I think that's only to make sure that the credit goes through. I assume. I have not spoken to them, but basically this is selling your receivable. There are lots of firms that provide that service. It does cost, but if you need that money or you want that money sooner rather than later, then maybe that's a really viable point. What I'm not sure, and I didn't read the details, is that holdback a flat dollar amount? Is it a percent? I'm not sure. I'd have to get into those details. Again, I'll try to reach out to them and see if that's something that we can maybe partner with them as well, or even just refer you to, to them. If that's the case, then our fee would be the same. When you get your portion of the credit from them, we would take our 15% of that piece. And then when you got the final refund, the holdback, we would take our 15% of that when you got it. So we get our 15% when you get your full refund portion, okay? Now our 15% would be before their percent for factoring it. I know that gets all confusing. If we didn't have the necessary reduction in revenue, is it still worth trying to get the credit? Keith, I absolutely think so, but I am not your typical conservative CPA. So there is that to know about me. I'm not ultra aggressive by any means. I like to be able to sleep at night. But that's the whole point of this is, think about how many employees do you have? You have the potential. If your employees average $40,000 a year in annual wages, then you're looking at a $26,000 credit per employee. So do you have 100 employees? All good accountants have a 10 key. Not anymore. They do it on the computer. That's $2.6 million credit. That's if you have 100 employees. Again, there's all the other rules that go in with it. So my answer is it's absolutely worth it. But I think if you're really small, you're going to have this 5% upfront fee. If it's a $20,000 credit, maybe it's not. But if you're really small, $20,000 credit minus 15 for fees, that's $15,000, still a lot of money to you. So I'm not setting any minimums other than there is this $5,000 minimum fee. I want to be non-discriminatory and calculate the credit for as many people as want the help. My point here is to deliver the help and make sure that we're meeting your needs and that you don't have to go somewhere else, because I think I feel comfortable and I feel privileged to have built up a lot of trust with a lot of you all out there. So I've had a lot of people come to me and want this, so I want to be sure and offer it. So that's all I got. The follow-up email will go out tomorrow. It will have a recording, it will have these slides, and it will also have a link to our engagement letter. Again, it's super easy to sign. Sure, that's a great idea, David. Another question just popped in. There is an FAQ. I will make that a link as well. Can I post a link? Yes, I can post it as a link. That follow-up email goes out of Zoom system, and I cannot attach attachments, but I can attach links. And so I will link you straight to the IRS website. So Michelle, will you jot that down as well? Michelle's my handy dandy. She's my person, if you ever watch Friends. And anyway, she's making notes for me. If we sign the engagement letter and then find out we won't qualify due to WOTC or other reasons, do we still pay the upfront fees? Another great question. Again, I want to be clear. I'm not here to just collect fees and say, oh yeah, you signed up, I already drafted it. It's just not how I work. Absolutely. Now, if we have to retain the law firm, and because I'll be able to ask them right up front, hey, what about somebody that gets WOTC credits? How does that play in? And if they say, yeah, WOTC credits, I don't think just getting WOTC credit excludes you. That's not the case. It would be that we could not double dip the wages. And I don't know the WOTC rules enough, but I know that it's only a portion of, let's say somebody's paid $30,000 in the year. I mean, I think your credit's like 3,000, maybe 2,000. That still leaves a lot of wages available. So I don't think that that would exclude you from wanting to do the credit. It would just reduce your credit a little bit. So be clear on that. The other thing that I'll be very honest, I'm super transparent, that I'm trying to find out is, do the attorneys feel like 90% of you are going to qualify? 99%? Are they feeling like so far every home care we've worked with, we've qualified them? If that's the case, then I'm going to say, go for it. We're going to start getting these opinion letters. If they say, yeah, not so much, then and if that is the case, then my thought is I'm going to start getting the credits calculated even maybe before the attorneys finalize their piece, because we can do that simultaneously. If they say, you know what, it really is a one-by-one assessment, then what we're going to do is we're going to have to spend the $3,500 up front, find out if you qualify. If they finish the meeting and their analysis say, yep, they qualify, we just need to do the letter, then I will charge the $1,500 to then start the credit and get the credit calculated. So if they're more like, yeah, 99% qualify, then we're just going to go ahead with the 5,000 and get the opinion letter going and get the credit going. If they come back and they say, yeah, really needs to be a one-by-one, then we're not going to do the credit calculations until the legal team has said they qualify, let's move forward. So it could be 3,500 or the 5,000. I hope that clears that up. Again, for those of you that have already signed an engagement letter, I haven't drafted anything. Also, those that want to sign an engagement letter, I'm not drafting immediately. I will notify you individually that, hey, here is the plan. We're going to go ahead and draft these, because I'm going to come back and either say, all right, if you listen to me, attorneys are confident, everybody's a go, we're going to draft and get rolling. Or attorneys are not confident, they want to meet with everybody one-on-one, we're going to draft the 3,500, we're going to start scheduling appointments, and I'm going to let you know one way or the other. Now, I'm only going to put that out to those that have engaged us. So that's really where you want to be to follow developments. So anyways, that's what I've got. Are there any more questions before I wrap it up and call it I'm not calling it a day. I have several more meetings today, but I'm going to wrap it up and take a break and get all of our follow-ups set. Thank you for the happy birthday wishes. I appreciate you guys always tuning in and giving me space to share what I know and my desire to just be able to help. It's been hard the last 6 months. I've had to say no to a lot of requests, a lot of people that need help that are not our regular client. And That's hard for me, but we've had to do it to be able to help those that are our monthly clients. So anyways, I appreciate you guys, and stay tuned tomorrow for the follow-up emails, and let me know if you got any questions. I appreciate you guys. All right, thanks.